Hello, good afternoon, and thank you for attending. My name is Justin Ford, Director, Life Insurance and Annuity and Long-Term Care Sales Director. Justin by short is what I prefer. Thanks again for attending. Before we get into today's topic, which we're going to be covering some exciting, several exciting topics, strategies, and actionable ideas that you're going to be able to leverage within your practice, your prospect base, in your sales funnel, and with existing clients to help them at the same time help you build a stronger and better business here in the middle, starting out in the first of the year here, 2023. But with our audience, some of which of you are joining us for the first time, checking us out, and some are partnered with us and have been for some time. I want to thank both audiences for being in attendance today. Appreciate your time. We're going to cover, first off, the incentive. If you are new with us, we have a incentive in which we're going to help jumpstart your marketing in conjunction with joining and coming on board with IAMS. When you write your first cases and you submit your first business through our organization, during your first 180 days coming on board with IAMS, we are going to pay you additional compensation by way of covering several items based on what level you hit as far as submitted business. So as an example up on the screen, $100,000. So you come on board with us, you're in your first 180 days, you submit $100,000 worth of annuity premium. That could be 10 cases, it could be one, or 10,000 as an example in target premium. Target life would be a tenth of the premium here, just as one example. That would get you to the first level. And in that case, you're going to have a choice between us covering a 1,500-piece postcard mailing, topic of your choice to get responses back for new potential prospects, an iPad, or $750 in cash, or our marketing analysis and corporate identity package complete with pre-formatted emails. For those of you in the audience that enjoy retyping the same thing over and over again when you get it right the first time. So pre-formatted emails that we have all set up for you. And all the way through as an example here on the screen, submitting $1 million or $100,000 in target premium during your first 180 days, going all the way through preset appointment programs, custom-made videos, not to mention covering any existing prospecting seminar or workshop program that you may be doing. Sky's the limit. Our overall goal with this, ladies and gentlemen, is to help jumpstart your activity with us during your starting orientation with in our relationship together, so that we can show exactly how we honor our promises, and so that you can evaluate and your staff can evaluate and get used to us faster, so that we can be more effective together as we collaborate and move forward building revenue. So we're going to compensate you for it. If you have any questions on the program, talk to your primary contact or who brought you on here at IAMS, or reach out to myself, Justin Ford, or Beth Rickcliffs in Life Insurance. We'd be happy to answer any questions that you have on that topic. In addition to that, those of you on the phone, both audiences can relate to this. Many of us use referrals and introductions as one of the primary ways to build relationships in our practice. We're going to be covering some strategies today that may yield some of those referrals. We, too, at IAMS build our practice in a similar way. We'd prefer to work with those that fit our overall mold, like those of you in the audience, and we find referrals are one of the better ways to do that. We have a compensation program to pay you outside of our pocket for anybody that you happen to refer to IAMS. Appreciate all the referrals that have come in from those of you that have referred folks here. Here's how our referred bonus program works. We're going to pay you in a number of ways. First way we're going to do that is after you introduce or refer that producer over to us, myself, Beth, our staff is going to take care of getting that agent licensed. And once we do so and they get contracted with their first carrier, we're going to pay you a $50 one-time cash bonus. In addition to that, every time that producer comes after they're licensed with us, writes business, we're going to pay you basis points on their life, indexed annuity, single premium life, and multi-year guaranteed annuity business for the life of their existence and writing with IAMS. That comes out of our pocket, not theirs, not yours, and it's our way of saying thank you for the referral. In addition to that, once you and the referral come on board and you're writing business with us, as those that are already writing business with us know, we have an ongoing what we call marketing reimbursement account. So these are all in addition to the commissions that the carrier pays you directly. Marketing reimbursement, we're going to pay $100 per $100,000 in annuity premium, $200 per $100,000 in single premium life premium, $200 in per $10,000 of target life premium. So great opportunities here. We're going to be talking about all these products today to get additional monies in your pocket as you write business with us. And then that's also in addition to whatever the carrier may pay. So if you have any questions or would like to learn more about that program, definitely let us know, and we'd be happy to help. One of the items we take most pride in and that we hear most about is our service here at IAMS. More so than I'd ever imagined, service is even more so important. Not that it couldn't be already as we approach and came through this pandemic. As many of you may have seen in your communities, it just seems like service has kind of gone by the wayside. And we take our service guarantees with pride, try to answer the phone within 2 to 3 rings. When you call in, you always get a live person, so we don't get stuck on the hold triangle. In addition to that, we have individuals on our staff, once you do write business with us, and that business comes in, that will follow up on any of your 1035 exchanges, wait on hold with the ever-growing length of hold time due to service issues at insurance carriers. Many of you may have experienced that during this recent rate increase hike. But Amber here and her team on our annuity new business side, and I know Michelle and her team on life, holding is what they do. You may make, and I know for a fact many of us make more per hour when we're not holding on the phone, and that's our objective. Anything we can do to maximize your per hour revenue to get you in front of places where you make the maximum per hour revenue, which is in front of your clients and in front of opportunities to gain more clients. So we'd like to take all that off your shoulder. That includes everything from case design all the way through submission, anything in submission and commission support. Also electronic applications. We'll talk about that here in a second, or right now. We've got on our website, we have the ability to do business digitally. We partner with Firelight, and we also partner with iGo. iGo is primarily where you're going to see your life insurance, digital applications. Right from our website, you can, it's simply, when it comes to guaranteed universal life, or, to term insurance, you can actually take the quote right there and submit the application within the same time period, in the same seat, on the same computer, and be done with it, and be confident that it's virtually error-free when it gets to the carrier. Same thing with annuities, using Firelight right from our website. You do need to sign up for Firelight, so if you'd like to start submitting applications, as an example for annuities, getting paid in many cases within 24 hours, having policies issued within 24 to 48, and being error-free, and an easier way to track your business. If you want to sign up with Firelight, let your primary contact or myself know, and I can get that done for you. Simple process on our website, and we can start getting an orientation. When it comes to life insurance, you're ready to go. You just need to be contracted and access to our website. And if you have any questions, reach out to us. We'd be happy to help, myself or Beth Radcliffe's. Many companies are coming on board. I'd venture to say, love it or hate it, the companies are going to be going, are arguably heading the digital route. The good news is the program has gotten a lot better than it was when they first started doing this back in 2010. Don't know what happened to my slide presentation here with the background. I apologize, but I will get this to you, creative marketing solutions. So we've talked about your back office. We've talked about jump-starting your business the best way we can in the beginning. In addition to that, we know that many of our producers do phenomenal jobs in their community, changing people's lives every day. And in many cases, we may not work on our own business as much as we work on helping others. So when it comes to your community, are they aware of how important you are and what you do for your community? If not, as much as you'd like, would you like a branding package put together? What our creative marketing service team does here is make sure that we are the velvet behind the diamonds, you are the diamonds. Anything we can do to enhance your professional image, anything that you may be working on as far as your current marketing events, seminars, if you need a little graphic design assistance, something as simple as a logo design or a business card, all the way through advanced navigation through a fully integrated social media marketing plan built, customized for you and your practice. We can do both ends of that spectrum. We have a team here in-house that is employed entirely by IAMS. We pay for their benefits. We pay for their grief, their time off, and their education. And by doing that, we maintain the rights to understanding the markets that they focus on. They only focus in the financial services and insurance planning markets like we do. Therefore, they are experts in that field, and you have access to them at the tip of your fingertips by reaching out to us. And urge you to do that today if you haven't done a marketing action plan, or if you have interest in enhancing anything within your practice from a creative standpoint, let us know. The other benefit here is we do not own or maintain the rights to anything we design for you. That is your proprietary material, unlike some advertising local firms that may utilize some of the items that they may have created for you with other businesses, or try to get you to pay for something that you shouldn't. Ours is based strictly off the business that you write. So if you have any questions, please let your primary contact at IAMS know. In addition to that, you can always reach out to us via phone. For those of you that would prefer to do a little research on your own, or if it's after hours, you can also access our website at iamsinc.com. Easy to register. Once you're appointed with us, you can do that right on the website. And inside our website, it is going to give you access to the e-applications we discussed, forms. You can download any form to include in-service forms, income withdrawal forms from any of the carriers, to include application packets for new business as well, right from our website 24 hours a day. You can also do, and we're going to get into this, show you an example, customized income rider reports for annuities. You can also do that for life insurance with guaranteed universal life and term insurance, current rates for multi-year guarantee annuities, customizable education pieces on topics ranging from everything from special needs trusts, buy-sell agreements, all the way through Section 162 plans. Sky's the limit. If you need a piece that goes through a very detailed, like IRS or government or estate planning topic that's timely and accurate, that you'd like to put your name on, we do have access to those items in our marketing corner sales section. So check that out, or let us know. We can, Beth did a webinar not too long ago going through the website. I'd urge you to check that on our YouTube page, because she goes through where some of these items are located, or give us a call. Those of you in the room that may not be aware, we do have a corporate RIA, IAMS Wealth Management. We partner with our advisors here, anybody that may be considering getting their Series 65 and just has questions, or those that already made the decision and want to move forward, getting their U10 window open up and start taking their exam, getting their materials together. We can help with that. Reach out to us today. If you're currently with an RIA and you're looking at transitioning, maybe for lower fees, which I've heard we do fit that bill, or a better relationship when it comes to annuities, life, and wealth management solutions, give us a call. Reach out to your primary contact, myself. We can get you a conversation with Duncan and get you the scoop on IAMS Wealth Management and see if we can help. Life and Annuity Academies. We brought back in full force our 2-day producer academies, where we cover sales, advanced sales ideas and strategies with 4 top producers in the room while rubbing elbows with other attendees. We break apart strategically indexed annuity products, life insurance products, go through turnkey solutions for prospecting from top producers, go through several large life insurance case marketing strategies and case studies, business insurance concepts, industries, best income riders, wealth transfer tools, advanced sales topics ranging from estate planning all the way through what in the heck's going on with our taxes going forward. We're going to be covering all this. Our next one is up in April, coming up in April. If you haven't signed up to get on the list for our academies, I urge you to go to IAMSinc.com today and do that, or let your primary contact here know that you'd like to get on the list, because they fill up fast, and we want to make sure if you have an interest in one of the academies, we get you on our list early on. Speaking of trips, we are in the middle of our producer incentive trip this year. In the qualification period, we're going to the Seaside Sanctuary in Kauai Island, South Carolina. And little different on our qualification trips. Takes $4.5 million in premium for annuities or higher to qualify for the trip. 450,000 in target is the breakdown equivalent. Talk with Beth specifically if you do focus on the life insurance arena with us. She can help you with making the merger on those calculations. But 18-month qualification period. So we don't rely on just 12 months. Our qualification period started back on July 1st through December 23rd of this year. The trip is next April. So look forward to seeing you there. For those of you that do much more than the qualification portion, might be interested in top 20, have a trip extension opportunity. You'll be staying the 18th through the 20th, switching to the Charleston Place in downtown historic Charleston. So look forward to connecting with you guys at that event. And if you have any additional questions about IAMS in general, definitely reach out to us. Without further ado, I'm Justin Ford. I'm going to be our speaker today. I'm going to cover max strategies. We're particularly referring to annuities and insurance products here. And I brought Beth Rickliffs from our senior life insurance director here on the phone with us to help with some of the strategies that are going to allow us to potentially help a client out, give them more of what they're looking for in several scenarios here, but then also double our revenue streams to where we can receive a stream of revenue from annuities and life insurance for just doing the right thing potentially for a client. Any of the strategies today, just so you don't have to hurt your hands on notes, I will send out this PowerPoint deck that has the individual strategies on it, as well as a care package as we loop back around with you. I have a polling question I'll ask here in a moment for those of you that want us to follow up. So we're going to go through 4 of these today, and the first of which is going to focus on our good old friend, Mr. Certificate of Deposit. And we're going to go start with that right now. So each one of the concepts here, I've got a case study put together. You may recognize some of the slides here from our sales conference where I did part of this strategy presentation in the on-demand section. But it's an ongoing thought. What we're looking for is, in working with cases that we put together and design, we're looking for great stories to share. You are with your clients, looking for great ideas that are actionable and affect the risks or the challenges or concerns or pain points, if you want to call it that, of the clients that we are here to protect and help. So having a book full of these can be good, and that's where we're getting these from. So we'll cover some today. They're ever-changing. And certificates of deposit, traditionally considered safe vehicles for sums of money, as many of us may be aware. Interest rates have risen, making these more popular recently after the MIGA wars at the end of last year. So we're starting to see that. Now, obviously, banks are, in the time we're going through right now, banks aren't in the best light, but at the end of the day, the products themselves still are there withstanding. People are happy with the FDIC backing, or what they believe to be the FDIC backing, and they often appeal to consumers who are seeking to guarantee their money in a location and understand they'll take a decent interest rate for that, but they also have the downside protection. But we know CDs, while offering the guaranteed rate of return they generally don't do really well at hedging against inflation, especially for the long term. And that's the market that many of us are in, is the long and short-term stages of retirement. Over time, that CD can lose real value and be eroded by inflation and taxes. On CDs, non-qualified CDs, as we know, we are paying taxes on the return interest each year. And if we started to utilize some of these for income, we can also be affected by inflation as well. So it leads us to what we would call, and I like this saying, going broke safely. CD strategies can turn that way, but it's really, we're looking at a pattern that situates the consumer between a safe rate of return and products with a higher risk opportunity. So perfect chance for an indexed annuity or a fixed annuity, potentially. But let's look at June and go through our first scenario. So here's an idea that's come up, a real life case. We just changed the name to protect the innocent. Age 65, June, good health, non-tobacco smoker, no vapor, 22% tax bracket currently, and her CD rate, I took the liberty of not changing these rates, but is 2.5%. This will work for any number. Rate is 2.5% on her current CD. What she's looking to accomplish is she'd like to take some income off of the CD, but she wants to leave the underlying value of her original deposit in the CD to her heirs. So many of us have probably heard this story before. I certainly have. So she wants to take interest, but she wants to keep the balance there. So what can we do to maximize this potential leveraging the products that we have? I understand there's several different ideas. This is one of them that has been used. And so this is going to allow us to put more cash in the client's pocket and at the same time enhance the death benefit as well. So on the left side, we've got our current $300,000 CD that June's in. That's our current situation, and she's currently pulling her interest off, which would be an annual $7,500. That's that 2.5%. That's giving her an income after tax, assuming that 22% bracket. Quick math, $5,850 is her after-tax annual income, and she's still at any point, if she were to pass away, as long as those rates did not change or she didn't adjust her needs, she'd pass on the $300,000 to her heirs of tax-free money because it was principal. So how can we maximize that? If you look over on the right, if we leverage the power of an annuity and a guaranteed universal life policy, and in a little while I'm going to bring Beth on in a couple slides here to talk about how guaranteed universal life works, but just running with me here, you've got an annual pre-tax payout from an immediate annuity. So if we were to take the $300,000 and put it into an immediate annuity or a fixed annuity like an FIA with a free withdrawal, over a 10-year period of time as an example, it would generate $17,168 in annual pre-tax income. After tax, that would be $16,611. And then non-qualified money, if we do use an immediate annuity, the benefit here is you have a payment where you're only going to pay, as you know, pay taxes on a portion of that gain. There's an exclusion benefit or exclusion ratio. So we'll want to use an immediate annuity in this example. So we had 16 or 17,000, but only, and then we have 16,000 still that we're taking out. So there was a small amount of that we're going to pay interest tax on because the rest of it is principal. We're going to take $5,505 of that and pay an annual life insurance premium to a guaranteed universal life policy. And after everything is said and done, if you go down to the yellow box here, we're taking an after annual tax income now of $11,000, and we're also paying that premium of $5,500, which at the time, this could be greater now, but at the time paid for a $300,000 tax-free death benefit to pass on to her heirs. So all those numbers and all this talking to say the two things, if I had a pen, I'd circle it. She was taking $5,850, and she was able to pass on her $300. She was basically had a lien against her $300,000 to get her loan of $3,850 and pass on that money. Now we've given her more income, $11,000 and change annually. It's almost doubled it, and a tax-free death benefit for the heirs, $300,000 and tax-free with the same money. So there's one opportunity where we could do her scenario with. Well, June came back, and she also, if she could get it, would like some more liquidity in case of an emergency from the particular sleeve of money. So with a little changing up, we can actually allow her that option and offer some flexibility while still maintaining the income that she's getting. So previously, over on the right, previously her annual income off that CD was $5,850, and we were paying, and we're going to pay $5,505 for the guaranteed universal life. So essentially, make sure we get the slide here. If we break up the money a little bit different, we're going to put $105,000 of our $300,000 into an immediate annuity to get $5,850. $99,000 and change is going to go into a second immediate annuity that's going to pay only the single premium life. The guaranteed universal life of $5,500 and change. Oops. And so by doing that, if you look here on the slide, it's now working. You've got two immediate annuities. We're going to get the income that she was getting before. We're going to pay the guaranteed universal life that'll get us the $300,000 death benefit. And that leaves us with $94,000 in cash that we could either leave in a checking account, spend, save, or invest, and still have the tax-free death benefit of $300,000. So we've replaced the income that she was getting exactly before. We opened up some liquidity of about $94,000 and change, and we created a tax-free death benefit of $300,000. So what would this look like if we utilize single premium here? So we're going to break up our SPIA and do $105,781 to get our income off of the CD. We're going to take another amount of that money off the $300,000, and we're going to place it into a single premium drop-in into a guaranteed life insurance policy. So $122,432 we're going to drop in as a lump sum into that life insurance policy, and that in this case paid for $300,000 in the tax-free death benefit. It gave us a little more income than what she was receiving before, but we had $71,000 in liquidity. So as you can see, the important part of this slide is we can change it up, and I know Beth's over there eager to talk these numbers. Beth can probably get better or change, and we'll talk about some living benefits here in a second. But between Beth and I, if you have a case that we're working on here at IAMS, we'll partner up on both sides, and we'll get the right numbers to maximize whatever situation you're in and get the client what they're looking for and more, and you more as well. Now, not mentioned on the slide here, but of course, by doing this, we've picked up 2 commissions from the annuity and also from the life insurance. So what if June likes this concept, but she's concerned about the issue or the risk of a chronic illness? If that is the case, we have several products that can be a fit, and Beth will be speaking about some of these in a second. But the first up is single premium life. So if we're looking for, we've got a client, June, she's already a CD holder. Let's say that she likes the concept of simplified underwriting. Maybe there's a medical reason for that. Maybe it's just because of patients, but most likely medical. What we can do is get living benefits by using single premium life in this same strategy through Baltimore Life. Policies issue 50 to 85, and we're going to get accelerated benefits for terminal and chronic illness when we do this. So what we're going to do is same strategy we did with her before. We're going to get our $58.50 in income by tearing off $100,000 and change to go into an income annuity. That'll replace our income that June wants. Then we're going to take $165 from our $300,000 from the bank, and we're going to place that into the Baltimore Life policy. And it's going to get us the $300,000 tax-free death benefit, that $165 in this case. And then we also have almost $30,000 that we can use for spending, saving, or investing. So we can switch it up with the policy to meet the client's needs. So we get a situation there where we can actually get somebody that's less health focused, maybe wants to go through a quicker underwriting process, or that has, that we weren't able to run through regular underwriting, or we could do the regular underwriting product as well. So you could be as healthy as Beth or as not healthy as me, and we could still actually make the strategy work. How about that? So Roth conversion. That's our second topic here. So why is this important? Roth conversions have been a topic, as we've all heard about throughout the year already with some of the changes. But you look at the overall survey of Americans, most taxpayers are no longer, the majority of them are not subject to federal estate taxes anymore. But it doesn't mean that their income tax or that their assets aren't going to be taxed to death. And we can see that with the IRS. We've got one of the largest known generations ever, the baby boomer generation, who was retiring and moving wealth over to now the second largest, Generation X and Y. And that is a huge meal ticket for the IRS, quite frankly. And so doing things like shortening up and taking away the multi-generational stretch and making that a 10-year payout period can help pay for some of these programs that obviously we're spending on right now into the future. And so they're looking for ways to tax that in retirement. The challenge is when you're in retirement, we're on a fixed income. The time is now to think about this because we don't know what the future holds. We do know taxes will be a part of it, but we need to make some decisions today. And the reason for that is the majority of taxpayers today, their qualified assets are their primary earmarked asset for retirement. My generation has entirely, it seems to be in the foremost part, entirely qualified assets from ERISA plans. It's where our nest eggs are. So they're hugely subject to tax risk. So how can we make this work for us? IRAs and qualified funds are payable to non-spouses, but they have to pay out nowadays over a 10-year period of time. Income taxable to the beneficiary receiving them at that beneficiary's tax rate, whether they, at the end of that 10-year period or over the 10-year time. And they generally have no basis, which means the full amount is going to be taxable because the IRS allowed us to defer it while we were living. Generally, IRAs are going to be taxable for anybody that is not a spouse beneficiary at their current tax rate. So we've had some changes to that multi-generational stretch concept. There's going to be more to come within this topic as we see adjustments go forward. But these have less of an impact on the Roth. The Roth IRA distributions are generally received tax-free. However, most taxpayers have substantially more in their IRAs, and that's the challenge. So, and the reason for that is simple. There's a cost to contributing or doing a conversion. So the reason why we have more unqualified and haven't done as many conversions is because of their current tax situation, and there is a cost. You've got to pay the taxes if you do an in-force conversion while you're living. So in other words, if my dad wanted to make sure that my sister and I had tax-free income, he could do a conversion now or over 10 years, but he's going to have to pay the taxes out of his pocket at his tax rate, which may for many be a great strategy, and it still could be, but many people may not have that lump sum to pay the taxes up front. So there is another way to do it, and we're going to go to option B, and we're going to leverage something called life insurance. So life insurance is on the account holder's life, so the IRA owner's life, at the face amount equivalent to the potential income tax liability, can help the spouse, the remaining spouse, pay income taxes to do a Roth conversion once the owner dies. So the concept is illustrated coming up here, but not only will, we're going to use an IRA, not only will the Roth IRA grow tax-free during that surviving spouse's lifetime, but it will also grow tax-free for an additional 10 years after they die, and will generally be distributed to the heirs tax-free at that time too. So this can be also a way to get around some of these, like a backdoor Roth, get around some of the concepts, or taxation. So here's how it works in a very big presentation, or a very big chart here. So dad has an IRA and passes away. He gives the IRA over to his wife, mom, and mom creates a rollover IRA. When dad was living, he had a life insurance policy created that covered the tax liability. So upon his death, if you can see my cursor here, dad passes away and gives that tax-free death benefit to mom, and she uses that tax-free death benefit to pay the taxes on the conversion. So this is where we get a little snazzy, and we don't do the conversion while mom's alive. We prepared for it ahead of time with life insurance. We're going to pay for the conversion with the life insurance premium. So now mom converts that IRA into a Roth. Important point number one, because now she can use that for supplemental income. And one of the reasons she may need supplemental income is if she wants her lifestyle to stay the same. And we know that the majority of dad's money and her money was in qualified assets. When she becomes a single taxpayer after the widow's period, she is going to experience the benefits or not benefits of being single, because the single taxpayer rates are higher. So in other words, to maintain her same level of income that she had while her husband was alive, she is going to have to dig more into her qualified assets at a higher tax rate, because net is going to be, she's going to have to take more to get more net. And if we do the conversion, that alleviates that problem, because now it's dollar for dollar. In addition to that, we're going to have a chance to pass it on to the kids tax-free, because now that we've done the conversion by pre-thinking the life insurance up front, while we probably had a healthier profile for dad, we also pre-thought the tax liability or risk, and we're also passing on any remaining proceeds tax-free to the children. So in addition to that, and Beth, are you on with us?
Yeah, I'm here.
Excellent. So I was just going through this, the Guaranteed Universal Life. Some of the stuff could be updated. In addition, could be utilized with different products. I imagine you probably have ways that we could do the same strategy and get tax-free income via loans for college planning ahead of time, maybe using an index universal life. You want to speak to that a little bit here, get your thoughts?
Well, there's lots of different ways that you can utilize life insurance to help this strategy out. One thing is if it is a cash value life insurance policy, even when dad's alive, that gives us a different bucket of funds that we can utilize to last longer in retirement if the market is down and so forth. But I think a bigger part is the reasons that we might need some protection when it comes to the biggest risk that we have in our retirement would be having some kind of chronic illness. So that life insurance, one way or another, you're using it for living benefits as cash value. You're using it for income tax-free death benefit to help mom out and help with any kind of taxes and a conversion. And there, if you look at the policies right, another thing would be looking at products that have an exit strategy to it. Because in this situation, buying the life insurance, if mom predeceases dad, then there might be reasons why we want an exit out of the life insurance, and you can do that as well. So there's lots of different aspects that life insurance can help in a situation like that. There's not one product that does every single thing, but depending on what the person's level of importance in their plan, life insurance is an excellent tool.
That's excellent. And little prequel, I think you might have been referring to a little return of premium exit strategy.
Yes.
Possibly. So here we go. So I don't, the other one, thank you, perfect transition, and appreciate that. Beth, return of premium max. So as Beth alluded, there are some reasons why you may want to get out of a life policy. We'll start from the beginning with this gentleman here, John here, unless he's got a different name on the next slide. But there are several needs that people are going to have in later years, the biggest of which are a need for life insurance coverage or death benefits, whether, to replace the cost or the income that you're giving to dependents, and then the need for chronic illness coverage, as Beth had mentioned as well, and a need for regular income. So with those three being said, a lot of people out there, as you find, as you meet with clients, may, like many, have a patchwork quilt, if you will, a patchwork of solutions to address their needs. And this is going to become important in the last strategy as well. But as you review a client's plan, oftentimes we're surprised at the different solutions that are patched together to solve different concerns. And many of those solutions aren't being bench tested against the constant change of regulation, political risk, product risk, interest rate risk, and tax changes. So question is it possible to meet all three of those needs in one solution? We gave it a try, and there is a way. And we call this strategy return of premium max. And the way this works is it's great for individuals that have potentially narrowing life insurance needs as they get older. So I fall into that category as my kids move on to their next stage in their lives with their families. They're not a dependent in certain cases, and as I get older, I have less dependents. That makes sense. So we're going to pay premiums for 10 years. In this case with John, we're going to wait 10 years and receive money back over 10 years, all the while maintaining permanent life insurance protection and making this fit for Mr. John. So, or Mr. Hank, excuse me. I knew the name was different, Beth. Hank, age 50. So let's start off with the case study. He wants $1 million in coverage, wants to be able to draw down that need in later years. So he wants a custom fit strategy to reduce the amount of coverage in later years because he will not necessarily need it. And he's also concerned about chronic illness in retirement as well. So mathematically, in this case, when we ran the numbers, Hank's going to pay $28,000 annual 10-pay premium, and that's going to create a $1 million life insurance coverage policy. He's going to wait 10 years while he's paying that premium, and he's going to maintain his $1 million in coverage while he does that. Then what we're going to do at that point, is we're going to do exercise the return of premium option on these policies. Now, Beth can speak specifically to different policies, how they work, but in general, we're going to receive back $28,000 for 10 years. In this case, on this illustration we ran, so it'll be basically paying back $28,000 a year for 10 years. And because of that payback, we reduce our life insurance down to $340,000 in tax-free life insurance coverage, and that matches Hank's needs because he no longer has the need for the full $1 million, but he does have a need for the income. And at the same time, the death benefit, the life insurance product has a chronic illness benefit built in. So we have chronic illness in case that risk comes up by leveraging the death benefit, and we also get that $10,000 or $28,000 back. So income reduced the need of life insurance. So we made it a better price fit. He could use the money he needed when he needed it for what he needed to. Same thing with the life insurance, and then also receive the chronic illness benefit. So you can see here graphically, the $1 million went to age 70 with Hank, then it steps down to $340,000 by age 80 and continues to age 100, guaranteed, leveling off. So we covered that reduction. The chronic illness benefit, at the same time, the chart looks really good for chronic illness because the client that chose to provide 2% of the life insurance coverage as a monthly chronic illness benefit, in this case, Hank, which would start out at $20,000 a month during his earning years. The benefit then reduces down to $6,800 a month during retirement. Now that would be important because during the earning years, if you have a chronic illness, it impacts much more, much faster. So you want that higher, same thing. So custom fit with the life insurance, custom fit with the chronic illness benefit, et cetera. And which leads us to, so Beth, going back to that return of premium strategy, is there anything in there that I've mentioned on the return of premium side as we go through that you may want to also bring in?
I mean, it's a great leverage of your money. You're almost in a sense, you're just moving money from one pocket to your other pocket. You know, it's still yours. You still have control over it. And not to mention that you get to take that return of premium back in the form of income tax free. So even though it's been growing tax deferred in the life insurance policy, that's one of the best things about life insurance is if it's designed correctly, the access that you have to your money is also tax favorable.
That's great. That's great. And understand up to the limits, if we were to have a chronic illness situation, those benefits can be tax free as well. Portion of them, right?
Yes.
So excellent. So far, I'm liking it. We're avoiding the IRS and we're getting things done here. Good job for Hank. So, we'll get these strategies out to you. If you have anybody that you want to explore that strategy with, reach out to us so we can do a design that can fit you a little more appropriate for your client. But we'll wrap up here with our final one: income rider maximization. So if we were in an audience, I'd ask for a show of hands how many people in the audience have clients that have money in an income rider annuity, whether it's variable or fixed indexed, or any of the annuities out there. Most hands would go up. And what we see is a big opportunity right now. One, we're in a pricing opportunity with these annuities based on the current interest rate environment and the underlying bonds that back up the insurance companies, to where they're creating and have an opportunity to create, and their options budgets are large enough to create really strong products right now. At the same time, we've got a large percentage of individuals in America that have and own annuities. And little facts you hear out there, one fact is 70% of annuity owners have listed one of the top 2 benefits or what they plan on using their annuity for. One of those reasons is for the cost of care, a care event like long-term care coming up in the future. Some of them are passing on, some are income. But how many of those out there are not in line with the client's objectives currently? In other words, the product may have been purchased at a time, and over the last 3 years, has anybody noticed any notable changes in our community? You know, the world changes, as sarcastic as that sounds. The world changes every moment. So when you get 10 to 15 years out, what has changed over 10 or 15 years that may have not been the same when the annuity was purchased? So a lot of times that's pricing. And a lot of times the fees on these riders have gone through the roof. What may have been a product that 2 years ago we didn't think we could replace with another annuity because of suitability, now the actual company is begging to take the money. We can get clients' income higher. So we've got opportunities as we review in-force contracts where they may be paying upwards of 4.5% annually for an income paycheck that we could get an increase to and reduce their net fees by 3.5%, 3.8% annually and get them a better income. or drop the income rider off altogether if things have changed. So we'll start off by, when we look at maximizing income riders, what are the risks in retirement? We know 3 of them right away: the risk of outliving your savings, the risk of reduced purchase power in the future or inflation, the risk of market losses early on in retirement that your portfolio may not be able to recover from. And this includes sequence of return risk. And any of us that were, obviously 2008 and you retired in 2009, you saw that firsthand. But those are 3 pretty big risks, arguably, other than taxes, 3 of the largest out there. What are the risks, I'd venture to say, in owning an annuity that no longer fits? And so a lot of these needs can be addressed by today's annuities, but there's also a risk for a account holder that has not been meeting with their advisor or has an annuity that they may have not shared with us or we didn't think to ask, or they just haven't gone back and looked. If it no longer fits, there's some risks that go in parallel with those other risks. So risk of outliving your savings was a concern. Well, now, if you're in an annuity that doesn't fit, some of these clients may be rolling up their annuity or allowing their income benefit rider to grow each year, maybe even paying for a reset period of another 10 years to roll up in their income account value higher, because every year they get 7% in their mind that they defer. The challenge is we have life expectancy. So if you're waiting till you're 75, 80 years old to turn on an income benefit, you're reducing the impact of your death benefit by using your money and paying someone to borrow your own money back. So in other words, if you're 80 years old when you turn it on, your life expectancy is 89, you have 9 years of income checks that you're going to be receiving. And if those 9 years of that level income don't add up, and oftentimes they don't, to the original premium that you put into the annuity, you're just getting your own money back, and you paid a fee, some of which are 4.5% or higher each year for doing so. So that could actually reduce your death benefit because the fees are higher, and you're reducing money that you could have technically dropped the income rider off, done free withdrawals out of the annuity contract, and passed on more to your heirs. So, or had an advisor that worked with you in the beginning to turn that income rider on earlier and maybe stop taking money out of an account that was subject to market risk. So there's some planning in there, but also could be that you're young enough to where that's not going to be an issue, and the income rider is just not going to pay out the same as today's rider, so you could replace the product and get a better fit. But we don't know until we check, so I'd urge you to review your client accounts. We're seeing a lot of those come across our desks right now. I've got 3 statements this afternoon that have been sent over to me in similar cases. Second one is risk of reduced purchasing power in the future. Does the income rider the client have? So here's what we'd look for on income riders in force if we're concerned about inflation or having a hedge inflation. Do we have an income rider on their existing annuity that's level or some form of linked benefit to where you can either have indexed income that has a chance to increase and lock in each year, like Athene and Allianz Life do as an example in North American, or do you have a index like some of the companies where you can tie to the consumer pricing index? I think AIG is one of those. So are those important? Do they matter in the plan? Do they currently have that that now? One of the things I've been seeing at one time, your level income on your older income benefit riders was higher than the starting increasing or linked index income that would come out of products like Athene and Allianz Life. That's no longer necessarily the case. The new products have the ability of starting income and getting the increasing income. So you can replace the annuity in some cases. The client gets the same income, but every year it can go up and lock in, and they pay less in fees by doing a replacement. So it really pays to take a look at some of those that you may have thought could not be replaced before. You may have not been aware they were there, and line them up with your client's expectations. Does the client still need income or not? And if they do, then are they in the best annuity or not? Third, the risk of market losses early in retirement. We kind of talked about that, not being able to recover from them. The index-linked or increasing option on income benefit riders is something that oftentimes gets overlooked because we think, well, there's no guarantee that it's going to go up, and we all want to shop for the highest paycheck for our client. But here I'll give you an example of a case I worked on where this product worked out really well in conjunction With the client's largest annuity, which happened to be their Social Security payment, Social Security is arguably, in concept, the largest annuity out there. And client was receiving their Social Security income at a level amount, did not have any type of inflationary protection elsewhere. So what we were able to do is leverage the increasing income product from an indexed annuity with an income benefit rider, that every time there was an increase in the index or credited interest annually to that contract, the underlying balance went up by that amount, but the client's paycheck also went up by that amount and locked in. That could also be a fixed account. So many of these products, you can actually guarantee an increase each year with the fixed account on the indexed annuity. Now, the indexed annuity, of course, fixed accounts have historically not been all that large, but now I'm seeing them out there 4 to 5%. They're not guaranteed each year, but when you're coming into considering first couple years, the go-go years, as Dr. Ken Dykewald used to like to say, first out of the gate in retirement, maybe we do want to see a bump or a paycheck increase, or maybe we want to see moderate increases to hedge inflation going forward and match that up with the client's other income sources. So it's another way that we can take a look at leveraging income products that may have not been available. There are a lot of products coming due right now, both on variable and some of the older indexed annuities. And some of those are not doing too well on the returns, but more importantly, clients' needs are changing. And if we can beat the income, or drop a rider that the client no longer needs, we can have an opportunity to earn a commission at the same time help the client. The third one is almost all these annuities in the past with income benefit riders at a bare minimum may have had a doubler for some type of long-term care where they'd give you double your paycheck back so you get your own money back faster for liquidity if you needed it, but there was no tax benefit to doing so or tax offset. We do now have contracts that will give an income in the case where you need chronic or critical illness, or if you just can't. We've got one policy, guaranteed issue index annuity, that will pay a tax beneficial qualified long-term care monthly benefit when you need it if you can't do 2 out of 6 activities of daily living, and it's a cash policy. So your client gets a long-term care check. They don't have to turn in receipts, and anything that comes out of that money, it's got to be non-qualified for long-term care, would be tax-free. So there's a way to turn a non-qualified annuity that may be sitting on the shelf, clients using it, paying an income rider fee they no longer need. They can cancel the income rider fee, move it into this. You pick up a 9% commission on the product. It's 8% normally, and you get the client a way to get around the tax issue if they go on claim or need it for long-term care. So there's a lot of benefits of reviewing beneficiary designations in these annuities, and I'd urge you to do it, and we can help. So we're getting close to the end of our time here, and I'd like to appreciate everybody taking the time here to attend, and Beth, appreciate your expertise here as well on several of the slides. We're going to be reaching back around to everybody here. I'm going to go through a couple polling questions before we go, and if you have any questions, you can email me at justin@iamsinc.com, or if you have life insurance questions, beth@iamsinc.com. And we'll start out here with our first polling question of the afternoon. For those of you in the audience, as we talked about, that have interest in hearing more about IAMS Wealth, if you'd indicate so now, that this way we can have a conversation scheduled or reach out to you to get you connected with Duncan in our IAMS Wealth management team here and answer any questions you may have. We'll be collecting responses here a couple more seconds, and we'll close that one out here. I appreciate your time. We'll go on to the next one. Second one, if you are not already on the list and would like to be, to attend one of our upcoming academies, whether that be April, all expenses paid. We cover the flight and the food and the room to get you out there and all the training. And if you have an interest in getting on that list, let us know. We can definitely get you over the link. Point you out on the website and discuss that process with you as well. We're going to have several events coming up next. I think we've got a life insurance focused one coming up after this event, in which we're partnering in April with Athene. But I'd love to see some of you here. Appreciate your responses. And then our final question for the day here, this one, if you would like additional information on the annuity maximization strategies, particularly, or in addition, if you have a case or a strategy that prompted your brain as you saw one of these where you have a client in mind that you'd like to work something unique or custom, let me know and we'll reach out to you here, or your primary annuity contact will reach out to you and we'll go through those strategies. Just let us know here. Appreciate that opportunity, and we'll get a design going. A lot of annuity companies out there and carriers, make no mistake, each one of you in the audience are what make this this industry, and I'm proud to be a part of it. Appreciate your time today, and we'll be talking soon. Have a great afternoon and rest of the week, and I'll be talking to you later on.